The insurance signal freight operators are missing. Insurers are starting to price aging freight infrastructure differently. Operators haven't caught up. For most transportation and logistics operators, insurance has long been treated as a fixed cost, something you negotiate at renewal, park in the budget, and revisit next year. That approach is becoming expensive, not because the insurance market is broadly harder than it was, but because the logic insurers are using to price freight infrastructure risk has fundamentally changed. And most operators are still managing to assumptions that no longer reflect how underwriters see their assets. The shift isn't dramatic in any single renewal. It's showing up in the accumulation of things: tighter underwriting guidelines, stricter documentation requirements, reduced capacity in certain asset classes, and pricing that responds not just to claims history, but to asset age, maintenance records, and infrastructure exposure in ways it simply didn't 3 years ago. The data insurers are now using, and operators often aren't the clearest signal that something structural has changed, is what underwriters are looking at. Carriers are now using aerial imagery, AI-driven asset assessment tools, telematics, and real-time infrastructure data to evaluate freight risk, not just loss history and safety scores. Climate variables that once appeared in quarterly risk reviews are now showing up in daily pricing models, according to a 2026 Insurance Outlook report by ePay Policy. That shift matters enormously for freight operators because it means underwriters are continuously updating their view of your risk exposure, not just at renewal. For marine and port-linked freight, the picture is even sharper. More than half of all marine casualties in 2024 involved vessels over 20 years old, and industry data shows a 42% rise in casualty incidents between 2018 and recent years. Insurers have noticed. Aging fleet assets and aging port infrastructure are no longer rated on the same curve as newer assets, and the pricing divergence between well-maintained, documented portfolios and older, underdocumented ones is widening. Marine and aviation insurers underwriting cargo and logistics exposures must navigate growing risks tied to rerouted shipping lanes, port congestion, and geopolitical volatility, according to Deloitte's 2026 Global Insurance Outlook. That's not a temporary adjustment. It reflects a structural reassessment of what freight infrastructure exposure actually looks like in a world of more frequent disruption. What's driving the repricing mirroring? 3 forces are converging on freight insurance pricing right now, and understanding them separately matters for how operators respond. The first is asset age and maintenance documentation. Carriers are placing greater emphasis on documented spill prevention, emissions controls, and inspection records, particularly for older facilities and assets. For freight operators running aging rail yards, port equipment, or fleet assets without robust maintenance records, this isn't theoretical. It's showing up in underwriting conversations and renewal terms. The absence of documentation is itself being priced as a risk factor. The second is litigation severity. Nuclear verdicts, jury awards that run into the tens or hundreds of millions, have become a structural feature of the U.S. transportation liability environment. Insurance remains one of the most significant pressures in freight, driven by increased litigation and nuclear verdicts. This is hitting trucking particularly hard, but the exposure is spreading across any freight operator with significant ground-level liability. Older equipment and infrastructure create larger target surfaces in litigation, and underwriters know it. The third is geopolitical and climate-driven infrastructure volatility. The events of early 2026, Iran war, Gulf port strikes, Hormuz disruptions, rerouted shipping lanes, are not just operational problems. They are underwriting events. Reinsurers raised rates by approximately 37% in 2023, in part to account for climate risks, signaling that the risk transfer chain is repricing environmental exposure upstream, Environment+Energy leader. When reinsurers move, primary insurers follow, and freight operators end up absorbing the downstream effect at renewal, where operators are getting caught. The gap between how insurers are thinking about freight infrastructure and how most operators are managing their risk programs isn't a knowledge problem. It's a timing and documentation problem. Insurance carriers are reviewing data earlier than ever, making early renewal preparation essential in 2026. But most transportation and logistics organizations are still approaching renewals the way they always have, compiling documentation in the weeks before expiration, assuming modest annual premium escalators, and treating the process as administrative rather than strategic. That approach works in a stable underwriting environment. It doesn't work when underwriters are dynamically updating risk assessments based on asset age data, infrastructure condition data, and climate exposure models that are running continuously. By the time a renewal conversation starts, the underwriter's view of your portfolio may already be more fully formed than your submission. Older structures with outdated systems often face stricter guidelines, and data quality is becoming a more influential underwriting factor. Carriers are using drones, GIS, and AI tools to validate maintenance quality and surrounding exposures. For freight operators, that means the data insurers are using to price your risk may not match the picture you're presenting. And the gap between those two views is where coverage surprises happen. What the insurance signal is actually telling you. It's worth being direct about what insurance repricing in freight infrastructure actually means beyond the premium line. When underwriters start distinguishing systematically, using live data, between well-maintained assets and aging, underdocumented ones, they are not just setting prices. They are identifying which parts of the freight infrastructure network they believe carry the most unpriced risk. That's useful information for capital planning, maintenance prioritization, and long-term infrastructure strategy, whether or not you're thinking about it that way. The operators who are managing this well are treating insurance not as an annual administrative event, but as a continuous signal about how the market views their infrastructure exposure. They're investing in maintenance documentation infrastructure before renewals, not during them. They're having conversations with brokers about asset age profiles and geopolitical routing exposure quarterly, not annually. And they're building the case for their portfolio's resilience proactively, because that case now directly affects the terms they get. The underwriting market has already moved. The question for freight operators is whether their risk management programs have. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.